Inventory is way up in California, ballooning by as much as 99%. Yes, that means practically doubling in one California region. In this California market update, we're doing a deep dive into the inventory metrics to understand exactly what's happening right now in the Golden State. We're going to see how this inventory surge is already affecting pricing and what this means for California homebuyers going into the rest of 2025. I'm Jon Schwartz, your 1% commission California Realtor. I charge my clients less so that they can afford more home. If you're buying a home in California and want to learn more, sign up for a free, no obligation call at my website, jonsch.com. That's jonsch.com. Now let's get into it. So today we're looking at the latest numbers from the California Association of Realtors. These are numbers reflecting the market in June 2025. These numbers come out in late July 2025. And let's just jump right into it. This statistic shows active listings increased across all regions. And what's great about this chart is that it shows us our active listings growth year over year in gray, but also our sales growth in red. And the numbers are a little damning. In the Central Coast, sales were up 11.4%, but inventory was up 34.7%. In the Central Valley, we have a sales decline of 0.8% and inventory growth of 46.9%. The Far North, which is a relatively small region, saw sales climb almost 14%, but saw active listings grow almost 24%. The Bay Area saw sales climb 1% and inventory climb 43.1%. And finally, my home market, Southern California, sales climbed 1.9% year over year. But look at this. Inventory climbed 99% year over year. So statewide, that gives us a growth in active listings of 42.5%. This chart goes back to January 2015, and we can see active listings grew in 2018 and 2019, then really fell off when the pandemic hit, grew again in 2022 and into 2023 when rates doubled. And once again, we are in a period of inventory growth. The number of active listings on the California market in June 2025 is the highest level since October 2019. Of course, where we are here, October 2019 is back there. And this graph, if we take a second to look at it, actually gives us a much better understanding of what all these percentages mean. Let me show you what I'm talking about. So first, I want to focus on our normal pre-pandemic years, 2018 and 2019. And you'll see over the course of even just 1 year, inventory can fluctuate quite a bit. 2018 inventory started around 40,000 units. And by the summer, inventory was around 65,000 units. Let me do some quick math via my computer. And that right there is a inventory growth of over 60%. And that's just in the course of 1 year. And that, of course, is the healthy and natural cycle of inventory on the California or really any market in America. Inventory grows in the summer, falls in the winter. We have a similar but not quite as dramatic rise and then fall again in 2019. And even in these post-pandemic years, we see this natural undulation. So the fact that June 2025 inventory numbers are on par with October 2019 inventory numbers means that we're still a little lower than we should be because October is not peak inventory, is not peak summer inventory. And you can see what I'm talking about with this graph that California Association of Realtors puts out every month, which I love. It shows active inventory, but it organizes it by month. So we're talking about June 2025. Now, comparing it to past Junes, you can see that where we are now is much higher than where we were during the pandemic, but still not quite as high as where we were in Junes of 2018 and 2019. So inventory is coming back strong. The percentage growth numbers year over year are huge, but for perspective, we're still not back to where we used to be. Now, you would be smart to make the point right now that, well, demand isn't back to where it used to be either. Demand is rather anemic. Sales volume is very low, right? So is this a risky amount of inventory to have on the market? Well, let's answer that question. And to do so, we look at unsold inventory. This is literally the number of homes left unsold at the end of the month divided by the number of homes sold during the month. And what you get is a metric called months of supply. And it basically says if sales were to continue at this rate and no new houses were added to the market, how many months would it take to sell out the houses that exist? June 2025, we're at 3.8 months of supply on the market. That's up from 3 months a year ago. This metric is great because it balances supply against demand. So it really gives you a sense of demand-adjusted supply. And indeed, growing over the course of the year from 3 months to 3.8 months is a 26.7% growth. So you could say even though inventory in SoCal grew 99%, and even though inventory across the state grew 42%, when you balance that growth against demand, we really only saw growth of 26.7%. And when we look at where we are now in terms of months of supply, we see that we're right in the middle of historical norms. This graph showing months of supply goes all the way back to 2005, and I added this yellow band here. And what this yellow band represents is kind of the peak and the trough of that 2013 to 2020, just before the pandemic period. And where we are right now at 3.8 months of inventory is smack dab in the middle of that band. So what's happening, and I've been saying this a lot, is that the market is not turning for the worse. The market is turning back toward a state of normalcy, which is good. It's healthy. In the macro, it's healthy for sellers and buyers. In the micro, it favors buyers, and we'll get into that shortly. It's worth noting that, of course, inventory across the state is not monolithic. This graph looks at unsold inventory for 3 regions, the Bay Area, Southern California, and the Central Valley. As you can see, Southern California has nearly 4 months of unsold supply on the market. That makes sense. That's where inventory has grown the most over the past year. And the Bay Area still has less than 3 months of supply of inventory on the market. So Bay Area home shoppers, it's still a seller's market up there. Okay, important question. Why so much active inventory? Well, this graph helps explain why. This graph shows us the number of new listings on the market this month. Now, new listings are newly listed properties that came to market in June. Active inventory represents all homes for sale in June. And when we look at new listings, in June we had 20,460 new listings, which represents a 5% decline from 1 year ago. So active inventory ballooning, new listings shrinking. So the new inventory is not coming from new listings. It's not like sellers are rushing to market to sell, which is good. If sellers were rushing to market to sell, that would be the indication that maybe a bubble had formed and people are now trying to get out of it. That's not what's happening. Sellers are slowing down listing their homes, which means the added active listings are the result of inventory sitting on the market longer. So fewer homes are getting listed, but the homes that are being listed are sitting on the market longer. That's a favorable situation for home buyers. So next important question, how slow is the market getting? And we find the answer in this graph, time on market up from last year's level. This is average days on market for a home in California. A year ago, we were at 18 days. Now, June 2025, we're at 24 days. That is an increase of 33.3%. And the reason why I keep bringing up these percentages is because it's interesting to think about the market in terms of percentages and how that actually affects home buyers and home sellers. Saying that inventory is up 99% sounds really extreme. Saying that unsold inventory is up 26.7% is much more moderate. Saying the market has slowed down by 33% is somewhere in between, to be honest. I mean, if you were driving and you slowed down 33%, you would certainly feel it. And a 33% slowdown is not insignificant. At the same time, it's not a halting. It's not a, dare I say, crash. Rather, it's a favorable environment for home buyers. So obviously, when homes are selling more slowly, typically sales volume goes down. Fewer homes sell. How many fewer homes? Well, again, we have news that's maybe mixed for the market as a whole, but generally positive for home buyers. Home sales are up 4% from last month, but down 0.3% from a year ago at an annualized rate of 264,260 homes. So the good news for home buyers is that sales are slowing down. That gives home buyers more opportunity to find the right home and buy the right home. The bad news, of course, is that sales have not nearly rebounded to where they were. We're used to home sales being in the 400,000 units per year range, and we still haven't broken out of the 260 to 275,000 units per year range. But again, we can see by the fact that this number isn't decelerating quickly like happened during the Great Recession, we can see that the added inventory is not conducive to or the result of some kind of systemic change in the market. And this graph is really interesting. And this is one of the reasons why I love the California Association of Realtors monthly release, is because it breaks down sales into price segments and really sheds light on what's happening in the California market. So as you can see, even though overall home sales declined, they actually only declined in the $500,000 to $1 million price segment. The $500,000 to $1 million homes share of market declined from 42 to 41%. You can see that homes that sold for less than $500,000 actually became a larger share of the market, and homes that sold for over $1 million became a larger share of the market. And we can see that there was sales growth in all price segments except $500,000 to $750,000 and $750,000 to $1 million. So in fact, even though overall sales are down slightly, sales are actually up for the lowest cost homes in California and up for the higher priced homes in California, and really only down for that $500,000 to $1 million price range. But of course, that $500,000 to $1 million segment is the largest segment of the California market, accounting for 41% of home sales in California. So how is all of this movement affecting pricing? Of course, that's the million-dollar question. In California, it's the $899,000 question. So pricing is down 0.1% year over year and 0.1% month over month to a new median home sales price in California of $899,560. Now, it's worth noting, if you can see on this edge of the chart, that is actually the second consecutive month of price declines in California, month over month and year over year. Last month, we also reported price declines of 0.1% month over month and 0.1% year over year. So what's notable, and what panic porn crash bros are going to want to point out, is that we've seen 2 consecutive months of price declines in California right in the middle of the summer, right at the time when prices are usually climbing. And these are real price declines, month to month and year over year. However, what a responsible real estate analyst should also mention is that these were literally the smallest measurable price declines at a time when inventory was, by kind of any metric, actually ballooning. But when you see the ballooning of inventory filter down to what that means to unsold inventory, what that means to time on market, and then finally what that means for price, and price is the ultimate meeting point of supply and demand, you see that the effect on price was minimal, extremely minimal. And that's an important lesson to know in California. California has a systemic supply problem. We don't have enough housing. So just because we're seeing inventory growth in California, it doesn't mean we're going to see price declines. And if you wait for serious price declines in California, it might be a long wait. But don't worry, there is some good news for California homebuyers. But first, and here's another one of these great charts from the California Association of Realtors, here's median price growth by percentile. So 0 to 20 represents the 20% least expensive homes. 80 to 100 represents the 20% most expensive homes sold in California in June 2025. And then, of course, you have the 20th to the 40th percentile, the 40th to the 60th percentile, and the 60th to the 80th percentile. And what you see is a divide right here. 60th percentile and above is where we saw all of the price declines. And 60th percentile and below, prices actually climbed or remained flat. I guess I should get rid of that arrow. Now, keep in mind the median price of a California, and that would be the 50th percentile. The median is $899,000. So while California Association of Realtors didn't say what that 60th percentile price point is, we can assume it's around, I'm going to guess, $1 million. So what this means is homes in California that cost less than $1 million are actually still growing in price. And it's only when you get past the $1 million price point to the more expensive homes, and especially the real top of the market, the multi-million-dollar homes, is where we're seeing price declines. Now, that's not great news for a lot of California homebuyers, especially ones who are shopping for homes at the $1 million and under price point. These, I think, are the most stretched home buyers because homes in California are crazy expensive. And I promise there is some good news for home buyers. But first, let's take a look at some regional snapshots to apply the data we've looked at to your neck of California. And we'll start with Southern California, where existing home sales is actually up 1.9% year over year. The existing home price is also up 0.2% year over year to a median of $840. The unsold inventory index, as we noted before, is almost at 4 months. It's at 3.9 months. Median days on market is 27, and the sale price to list price ratio is 99.2. Sale price to list price ratio is a good indicator of how strong the market is. When the sale to list ratio is above 100%, it means homes are selling for more than list price. And when it's below 100%, it means homes are selling for less than list price. So right now, even though we've seen some modest growth over the past 12 months in SoCal, because the unsold inventory index is pretty high, and because median days on market is slower than the statewide average, and because the sale price to list price ratio is 99.2%, that's under 100%, I think the next 12 months for SoCal might soften up a bit. Now looking at the Central Coast, a slightly more expensive part of California, existing home sales way up year over year, 11.4%. The existing home price, though, is down 3.1% year over year to $1,039,000. The unsold inventory index is at 3.8 months, just lagging a little bit behind where SoCal is right now. Median days on market is 20. That's faster than the statewide average. And the sell price list price ratio is 89.1%. All right, moving into the Central Valley, which is a less expensive part of California, existing home sales down slightly, 0.8% year over year. The existing home price also down 0.8% year over year to a median home price in the Central Valley of $499,000. The unsold inventory index is up at 3.7 months. Median days on market is just a day faster than the statewide average at 23 days. And the sale price to list price ratio is 99.1. Now we get to the Bay Area, where existing home sales are up year over year by 1%. The median home price is absolutely flat at $1.4 million. The unsold inventory index is still extremely low at 2.7 months. Median days on market also well below the statewide average at 20 days, and the sale price to list price ratio 100%. So even though pricing's been flat over the past 12 months in the Bay Area, this is still very much a seller's market. So we're probably going to see some decent price growth over the next 12 months. We would need to see inventory pick up, median days on market slow down, and the sell price to list price ratio to fall in order to expect softness in the Bay Area market. And finally, we get to the far north, the least expensive part of California in terms of buying homes. Home sales actually were way up this past year, 13.7%, whereas home prices fell 5.9% to a median sale price of $385,000. Tons of inventory on the market, 5.6 months. Statewide average median days on market, 24, and a sale price to list price ratio of 97.7%. Sales are up, but so is inventory. So I would expect the far north to remain a soft market for the rest of 2025. Okay, now let's talk about why all this mishigas is good news for homebuyers. Firstly, the share of homes sold above asking fell for the third month in a row to 35.3%. A year ago, we were looking at 47.2% of homes selling above ask. And of course, April 22, when things were crazy out of control, 72.9 homes were selling over ask. So if you're a homebuyer in the California market right now, there's a 2 out of 3 chance that you'll be able to buy the home you're pursuing at or below its list price. That's what happens when there's more inventory on the market. Even though prices aren't falling per se, or at least aren't falling by much, at least we have far fewer bidding wars bidding the pricing up over that asking price. When we break this down by county, we see that 5 counties have a majority of homes being sold over the asking price. 4 of those are in the Bay Area: San Francisco County, San Mateo County, Santa Clara County, and Alameda County. And then Mono County is also up there in the north of 50% category. This speaks to the continued strength of the Bay Area market. And the share of listings with a reduced price has also grown for the third straight month. It's up to 40.1%, with the median reduction amount being 4.8%. With summer beginning to cool down and come to a close, and the fall and the winter coming, this is definitely a time to start looking for properties that have reduced prices. Or what I like to do is find a property that hasn't had a price reduction yet, but has been on the market for 4 or 5 weeks, and then offer low. Induce the price reduction on your own. And over the past year, mortgage rates dropped 10 basis points from a average of 6.92 to 6.82. Rates are even lower now. And when prices drop a little and mortgage rates drop a little, those two compound on each other to create even more affordable housing for California homebuyers. So whereas price growth was down 0.5%, the average mortgage payment was down 1.7%. Now, this graph kind of has me scratching my head because pricing is actually down 0.1%. I don't know where the 0.5% comes from, but you can see in 2022, prices were going down, but because rates were climbing, the actual average mortgage payment skyrocketed. Hopefully, over the next 12 months, we'll have something of the reverse effect where prices stay pretty chill, and because rates drop, mortgage payments fall even further. And that's why the rest of the summer, the fall going into the winter is a good time to be a California home buyer. Inventory is up. And no, that doesn't mean the market is crashing. And no, that doesn't mean that prices are going to fall off a cliff. What it means is you have more time, you have more options, you have more opportunity to get a home at a more reasonable price without a bidding war. And that's what you should be looking for and taking advantage of if you're on the market right now. And your money goes even further when you're giving less of it to your real estate agent. That's why I charge 1% instead of the industry standard 2.5%. To learn more about affording more home by working with a less expensive agent, schedule a free, no-obligation call at my website, jonsch.com. That's jonsch.com. And subscribe for more California housing market news and updates like this one.